What happened? What happened to the numbers that we thought we were going to see and a little bit more relief that we thought we were going to see in the CPI print?
I think the Fed's still going to do 75 next week. I mean, there's an interesting situation where the markets are really focused on the data that they see right now.
I think the simple message is if you're expecting them to back off rate hikes in the short term, that's now not going to happen, and the market is adjusting for that.
I think that most likely what we're going to have is a period of stagflation. And then you have to understand how to build a portfolio that's balanced for that kind of an environment.
The inflation data raised fears of another outsized interest rate hike next week and sent stock markets into a downward spiral. Now, Ray Dalio also has a piece of bad news for the U.S. economy and the market investors. But one thing Ray Dalio is clear about is that it all starts with inflation. In this video, Ray Dalio goes on to explain how inflation, interest rates, markets, and economic growth relate to each other and what that means for what's ahead. So stay tuned, you don't want to miss this. Also, if you're new to my channel, don't forget to hit that subscribe button. Let's get into the video.
It's funny because, everybody says, okay, there'll be 7 increases or something like that, and that sounds like a lot. But you're taking interest rates up to something like 2%. And that 2%, which starts to squeeze the capital market, starts to make it more difficult for a holder of equities, because the equity, when you raise the return on bonds and you raise the return on cash and you tighten money, then that makes other assets less attractive, such as risky assets, particularly long duration assets like tech stocks and the like. So you produce that squeeze, yes, but that's still only at 2% or a little bit over 2% with an inflation rate which is considerably higher than that. So what you have is enough tightening by the Federal Reserve to deal with inflation adequately is too much tightening for the markets and the economy. So the Fed is going to be in a very difficult place a year from now as inflation still remains high and it starts to pinch on both the markets and the economy.
According to Dalio, inflation rates will remain significantly above what people in the Fed want it to be, as per the result of which it's hard to expect that interest rates will go down. On the other hand, what should be going up is expected to go down even more. Yeah, you guessed it right, I'm talking about the other markets going down. Not just this, the economy will be weaker than expected. In a recent LinkedIn note as well, Dalio sounded kind of murky on the economy and markets. His comments came the day data showed U.S. consumer prices unexpectedly rose to 8.3% in August. Dalio estimates inflation to be around 4.5% to 5% long term, and significantly higher with more shocks. This is how U.S. inflation moved over the last 4 months. From 8.6% in May, U.S. inflation rose to 9.1% in June, and later fell to 8.5% in July, and finally settled at 8.3% in August 2022. If the assumptions and estimates about inflation and real yields fall in place, Dalio expects both long and short rates to be between 4.5% and 6%. In 2022, there have been consecutively 2 hike rates of 75 BPS, and the Fed is set for another one. So stay tuned till the end as he discusses the market conditions and what an investor should do in this kind of environment. Before jumping ahead, be sure to like and share. Let's hear him out.
It's like, here's the problem. If you're borrowing more money than you're lending, and you have a lot of debt, you either are going to pay back in hard money or in soft money. And so it creates a very difficult trade-off. So what can you do? Do you spend less money? So that the trade-off becomes more and more difficult, and that's what brings about a stagflation environment, because they tried to navigate between those two undesirables. In other words, they want to contain inflation, but too high of an interest rate that's good enough for inflation causes too much economic environment. So what can they do? No, they're in a position already because of that dynamic, spending more than they're earning, creation of a lot more debt, and a lot of other debt, which one man's debts are another man's assets, and that as the holder of that assets is losing money. Imagine holding a bond now, and look at how much money is in bond funds and cash. Okay, not only in cash, you don't get any return to compensate for the interest rate. And in your bond fund, you get negative returns. And how's that feel? So you're going to continue to hold those bonds in that bond fund? It's a dynamic that they have to deal with that is really beyond their capacity to deal with it. They can't change those fundamentals. I think that most likely what we're going to have is a period of stagflation. And then you have to understand how to build a portfolio that's balanced for that kind of an environment.
Fed wants to reduce this inflation and go back to its 2% level. But for that, Fed is ready to put on with too high of interest rates. The market is also plummeting due to all this. Ray Dalio advises investors to balance their portfolio as per the environment. Should people be selling everything and getting out of the market because the markets are going down, or is it a time to buy? Let's see what Ray Dalio has to say on this matter.
What's happened is they produced a lot of debt and gave out a lot of money. And so everybody's got money, and it's also very easy to borrow money to buy things. And as a result, if you create much more buying power, then you create goods and services, you've got much more inflation. And the Federal Reserve has been behind the curve, slower to tighten monetary policy. And as a result, we're now starting to see the rise in interest rates to be able to deal with that. As that happens, all assets compete with each other. So now that free money is still going to be cheap money, but it's going to be a bit higher. So interest rates, let's say bond yields, have gone up about 1%. Now you take that and you adjust, everything is the present value of future cash flows, but it means that that interest rate goes up 1%. That means all the other assets have to adjust. We're in a process of making that kind of adjustment. That means the days that we've had before, the easy days where they dump money on you and you don't have much inflation and you don't have much tightness, those are past. And now we're in a different kind of part of the cycle.
According to Ray Dalio, we're in a very different phase of the cycle right now. One that is a bit depressing, actually. So is this the time to sell or buy? What is the Federal Reserve likely to do on rates ahead this year? How long will it take for inflation and market to cool down? Let me know your thoughts in the comment section below. And if you enjoyed the video and are excited to watch more videos like this, be sure to subscribe to my channel. You can also hit that bell icon to never miss any video. Adios and thanks for watching.